Welcome back to Am I Catching a Falling Knife? The podcast where we break down the latest stock market moves and help you decide if a recent dip is a disaster or a diamond in the rough. I'm your host, Dave, and today we're turning our attention to a pharmaceutical giant that's been making headlines, Eli Lilly, ticker LLY. This stock has taken quite a tumble recently, dropping over 20% in just the last few days. So, is LLY a falling knife we should steer clear of? Or is this a chance to catch a great company at a discount? Let's dig in. The single most dominant story driving this recent price action is the intense focus on Lilly's GLP-1 pipeline, specifically their obesity and diabetes drugs. We saw a particularly steep drop around August 7th and 8th, 2025. This wasn't because their superstar drugs like Mounjaro and Zepbound stopped selling well. Quite the opposite. Sales remained strong. The market's reaction stemmed from investor disappointment over the efficacy data of their experimental oral GLP-1 drug, orforglipron. This tells us the market is incredibly sensitive to Lilly's competitive position and future prospects in the lucrative GLP-1 space, especially as they go head-to-head with rivals like Novo Nordisk. Now, let's get a quick lay of the land on Eli Lilly itself. Founded way back in 1876, Lilly is a global pharmaceutical giant, headquartered in Indianapolis. They operate in 18 countries and sell products in roughly 125. Their revenue is heavily weighted towards cardiometabolic health. Think diabetes and obesity therapies like Mounjaro and Zepbound, which makes up a massive 73% of their total revenue. The remaining 27% comes from other areas, including oncology. From a geographical standpoint, nearly 70% of their revenue is generated right here in the US. So, how does this disappointment around an experimental drug impact a company that's already got successful GLP-1 products on the market? Let's break down the numbers to understand the estimated earnings impact. Remember, that cardiometabolic health segment is 73% of their total revenue. Even though orforglipron isn't a revenue-generating product yet, investor sentiment around its efficacy data is expected to temper overall growth expectations for the entire GLP franchise, simply due to increased competitive concerns. Our analysis estimates that this sentiment shift could lead to about a 2% lower than previously expected quarterly revenue within that huge cardiometabolic health segment for the upcoming quarter. Now, if 73% of Lilly's total revenue sees a 2% dip, that translates to a negative impact on overall quarterly revenue of roughly 1.46%. You get that by multiplying 0.73 by 2%. Lilly also boasts a fantastic gross margin, sitting at about 84.3%. So, applying that to our revenue hit, the estimated effect on gross profit is about 1.23% lower. But here's where it gets interesting. Pharmaceutical companies have significant fixed operating costs, things like R&D and selling, general, and administrative expenses. This means a percentage change in gross profit typically leads to a proportionally much larger percentage change in net earnings. This is called operating leverage. Assuming an estimated earnings leverage factor of 3.4 for Lilly, that 1.23% gross profit impact gets magnified. So, multiplying 1.23% by 3.4 gives us a final estimated impact of roughly 4.18% on their quarterly earnings. We're pegging the final estimated impact around negative 4.2%, with a confidence interval ranging from a 2.7% to a 5.7 hit. This range reflects the inherent uncertainty in quantifying the exact immediate earnings impact from news about an experimental drug, especially when existing product sales remain strong. The estimation of operating leverage also adds a degree of approximation. Now, let's talk valuation. To figure out what this stock is really worth after all that, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. This is a robust way to estimate intrinsic value. For our base case, we're using a future growth rate of about 42.2% and a discount rate of 9.5%, which gives us a base DCF value of around $794 per share. Then, applying our narrative's estimated earnings impact, that DCF value comes down to approximately $748 per share. The second method is a bit simpler, a PEG-based valuation. PEG stands for price over earnings to growth ratio and helps evaluate whether a stock's price is reasonable when you factor in its expected earnings growth. Based on Lilly's numbers, this PEG-based valuation gives us a fair value of roughly $764 per share. Considering the current price is around $640, both of these valuation methods suggest there might be some upside from here, even after accounting for the negative sentiment. So, what are the potential buy levels if you're looking to step in? Based on technical and fundamental analysis, some key levels to watch are $600, then $525, and finally a deeper level at $475. So, that's all about Eli Lilly. Now, a crucial disclaimer. Everything we've discussed today is for informational and entertainment purposes only. This is not financial advice, and you should always do your own thorough research and consult with a financial professional before making any investment decisions. The market is complex, and individual circumstances vary. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.